Oh, we can. This is our house. Good morning. Good morning. This is the New York City Fire Pension Fund investment meeting. We are at One Battery Park Plaza, and we are having a hybrid meeting. Some participants are attending by Zoom. Today is September 29th, 2022. The time now is 9:12 a.m. May I have a roll call of the trustees, please?
Thank you. Good morning, all. For Mayor Adams.
Bill Dukes for Mayor Adams.
Okay. For Controller Lander.
Okay, Allison, your mic's not working. I'll put you down.
Allison Hirsch.
Allison Hirsch for Controller Lander.
And John Dawson, alternate.
Commissioner Nyblack, Finance.
Shuman Ray.
Okay. For the UFA, Mr. Andrew Ansbro.
Bobby Eustace, Andrew Ansbro. Eustace, present.
Okay. And Mr. Edward Brown.
Yeah.
Mr. Eric Bischoff.
Virtually present.
Mr. Peter DeVita.
John Young with Peter DeVita's proxy.
Okay, John Young present. For the UFOA, Mr. Chris Jensen.
Here.
Mr. William Guilfoyle.
Here.
Mr. Jim Brosey.
Here.
And for the Fire Commissioner, Commissioner Brown.
Here.
Present. Okay, we have a quorum.
I will turn it over to Mr. Dorsa.
Thank you, Commissioner. So we have a couple of items in the public session, and then we're going to talk about some investment managers and go into executive session for that. So without further ado, I'd like to just acknowledge and welcome Steve Meyer, who is the, I guess it's still official to say new, Chief Investment Officer for the City of New York, for the Controller's Office. And he's going to walk us through the quarterly presentation. And, welcome to, I believe this is your first official fire meeting. So welcome and wow us.
That's good.
No pressure.
No pressure. Thank you very much. Is this on? Thank you very much. Well, everyone, it's nice to meet everyone in virtually and in person. I'm happy to be here. I'm grateful to be here. And I want to take you through what I've been told should be a Reader's Digest version of my normal presentation for the sake of time. So, Kate, if I can ask you to go to the first slide, please. So I'm going to continue to provide the typical market updates, economic updates that have been given to you in the past by prior CIOs, but I'm also going to focus on three recurring themes, those being the need for long-term thinking around these portfolios, the need for diversification benefits across your assets, also the need to maintain a global perspective on everything that we do for the portfolios, and finally, thinking in terms of time in the market and not market timing. The next slide underscores the fact that these are obviously very long-tailed obligations or pension promises. And this is an example. This is actually a headline from a Wall Street Journal article I read in 2020 when the last Civil War era pension beneficiary passed away. Her name was Irene Triplett. She was the daughter of a Civil War veteran who remarried and had her at age 83, and she lived to the ripe old age of 90. She was a mentally disabled person who, again, had benefit of her father's pension plan. So just an observation that these are very long-tailed obligations. This one was 155 years. The next slide. This is one of my favorite slides. This is the Callan Periodic Table of Investment Returns. And I put this up to underscore the fact that we never know which asset class is going to perform strongly. And it really underscores the need for diversification. This is a 20-year outlook of public markets. And with one exception, you can see that you really never know which asset class will come out on top. On the upper left-hand side, you can see those orange boxes. Those are emerging market returns. So for 5 years outperformed. The next year, they were down 58%. And the following year, they were up 78%. So it also underscores the fact that some of these asset classes tend to be more volatile than others. Next slide. This is just a reminder that we need to look at things through a global lens, that the U.S. is not an island. Your portfolio contains assets in both the public and private space that are both domestically located in the States as well as abroad. So our markets and your investments tend to be impacted by everything that happens around the globe. Geopolitical risks associated with wars, elections, trade pacts, and things even as common as the pandemic, which perhaps started outside the States. The next slide, and I believe you've seen this slide before. It's been presented. Typically, it has a title that says "The Lost Decade." I actually changed the title to say "Time in the Market" and not "Market Timing." And I use this to emphasize the fact that what you really want to expose yourself to is that upward to the right growth in wealth over time. This time frame is 120 years, not quite the 155 years of the civil pension beneficiaries, but it does reflect that even though the market sometimes goes sideways and then there's up and downs, again, you want to maintain a consistent profile in the markets to again, take advantage of that long-term trend. On the next slide, moving to our economic and market update. Inflation is top of mind these days. You can't open a paper or turn on the television without reading about it. It is at historical highs, both here and abroad. We haven't seen inflation levels like this for over 40 years. A lot of this has to do with the post-pandemic headwinds. We're coming out of the pandemic. There's an increased demand for supply, for goods, services, and experiences, while supply still lags. There's been issues and concerns about China's production. They have a zero COVID policy, which is creating lockdowns in their economy, and it's slowing the process of getting goods to those buyers and driving prices up. We also have significant labor shortage. It's also driving the costs of well, certainly labor, but also the cost of products and services higher. And finally, we've got a spike in energy prices. Some of that has to do with just pure demand as we come out of the pandemic. Others has to do with the impact of the Russian invasion of Ukraine on oil and gas prices abroad. On the next slide, the inflation outcomes that I just talked about certainly are well in excess of the Fed's, the ECB's, and the Bank of England's targets. They have a 2% stated inflation target. And you look at the UK, it's over 10%, the Eurozone 8.5%, and we're between 6 and 7% top line inflation. Next slide. Underscoring the fact that energy prices have spiked. This is West Texas Intermediate crude, domestic crude per barrel. The good news is it's come off the boil a little bit. Earlier this year, it traded at $120 per barrel on the upper right-hand side. It's currently about $83 a barrel, but we're moving into the colder months. And again, there are supply disruptions in Europe that may cause prices to move higher here as well. Next slide, unemployment rather. July unemployment hit a 50-year low of 3.5%. Moved a little bit higher in August at 3.7%, but it is still very, very low based on historical standards. The fact that employment's so low, we have a participation rate of 62.4 now. It had been 63.4 pre-pandemic. There are still 2 million workers that haven't come back into the marketplace pre-pandemic. And again, that's contributing to that lack of supply on the labor side and driving inflation higher. Next slide, economic growth. Actually, I love this slide. What this slide reflects is it's a 10-year look at GDP growth across the major contributors to global growth. And you can see that when the pandemic hit, it was a pretty universal spike down on the lower right-hand side. And the recovery has been a little bit more idiosyncratic as different economies have recovered at different paces based on fiscal stimulus, monetary policy, protocols around COVID. And I think the other really interesting thing and the thing that's powerful right now is that blue line that hovers above all the other countries. That's China's GDP growth, which for about 8 years hovered around 8.5%. And it had really been an engine for global growth. You can see it spiked down, it's recovered somewhat, but it hasn't recovered anywhere close to where it should be. And GDP growth in China, again, because of their zero COVID policy and their lockdowns, is estimated to be about 2.6%. And that's causing a drag in the economy there and certainly on the rest of the world. The next slide. This slide basically reflects 1.5 years of quarterly GDP performance. And I put this up here to underscore the fact that the last 2 quarters on the far right-hand side reflect negative GDP growth. First quarter of 2022 was down 1.6%. Second quarter down 0.6%. So typically you'd look at 2 consecutive quarters of negative GDP growth and say, well, there must be a recession there. But the U.S. consumer continues to be very strong. That's those gray bars that are all above the line. And the wage prices, the unemployment, and the employment picture is too strong. So I doubt we're in a recession technically now, although I certainly think we're heading into one given the actions that the Fed's taken. And I'll talk a little bit more about that in a moment. Moving on to the Fed, this is a reflection of the Fed's, what everyone refers to as the dual mandate, but there were really 3 points up there. And this is actually language taken from legislation that was passed by Congress in 1977, saying that the Fed's mandate is to achieve maximum employment, stable prices, and moderate long-term interest rates. And the thinking is if they can achieve stable prices, moderate long-term interest rates will come with that. One or two other notes. Fed Chair Powell has emphasized his resolve to get inflation down to the 2% target, even if it results in higher unemployment. He's also reflected that fighting inflation will bring some pain to households and businesses. And I think they've been very clear, and he in particular has been very clear that the Fed's mandate is to get inflation down. And if that creates a recession in the process, I think that's acceptable to the Fed. It's not their desired outcome, but I believe it'll be the likely outcome. On the next page, to kind of talk about Fed policy a little bit, this is a cool chart that actually reflects about 30 years of Fed fund or official interest rate changes in the states. And typically when the Fed raises rates, they do so in 25 basis point increments. In fact, since 1983, over a 39-year period, the Fed's raised rates 86 times. 75 of those have been 25 basis points. So this year on the far right, seeing the fact that the Fed went 25 from 0 in March, went 50 in May, and went 75 basis points in June, July, and September, it's unprecedented. The last time they hiked rates 75 basis points, they did it once in 1994, and the result was Orange County defaulted and went into bankruptcy. So something will break at some point, and we're seeing a lot of pressure, particularly outside the states. The next page. Let's look at interest rates. That orange chart in the middle, that orange bar on the left-hand side, that reflects where we started out the year, what the yield curve looked like. It was positive and upwardly sloped. The further out in maturity you went, the more yield you got. The upper yellow bar is actually today's yield curve, and it's inverted. And that reflects the fact that the Fed's been very aggressive in hiking short-term rates. And that inversion implies typically that a recession will occur at some point. And on the right-hand side, you can see the level of inversion. And it's jumped around a little bit. As of this morning, the 2s had a 2-year yields had a 38 basis point advantage over 10s. The next slide, Kate. This is a fantastic slide. This actually looks at global sovereigns or sovereign debt in the 10-year. These are all 10-year issues. And it shows the country on the left and the yield change year to date on the far right-hand side. So here you look at the top, United States, we've seen a 225 basis point increase in 10-year yields. And if you're taking a mortgage, you'll see that in your mortgage rates as well, because typically mortgages are priced off of 10s loosely. Every sovereign nation that's reflected here, with one exception, is seeing their rates go up dramatically. And I also have to call your attention to the UK, which is up over 300 basis points. And there are a lot of stress points in that market right now. The one country that hasn't had an increase in rates is China. And if you look there on the bottom, and you can see that their rates are actually come down 7 basis points year to date. And that's because they're cutting rates. They're trying to spur their economy to grow. And again, some of the weak growth has a lot to do with the zero COVID policy. On the next slide, a byproduct of higher official rates and higher interest rates in the States has been an incredibly strong dollar. The US dollar is at 20 and 30-year plus highs versus its major trading partners. And that's due to a few reasons. We have higher official interest rates here. We moved them up dramatically. We have a stronger economy relative to the rest of the world. We have reserve currency status in that oil is priced in dollars. That helps us in the States more than it does others. And finally, we've seen flight to quality buying in the US dollar given geopolitical risk associated with Russia's invasion of Ukraine and saber rattling by China in the Straits of Taiwan. The impact of a stronger dollar is there's a few things you'd think about as investors. So as the dollar strengthens, your large cap stocks, the S&P 500 stocks, they have considerable operations abroad. And when they bring those dollars, those earnings back and convert them to US dollars for reporting here, they're lower. So that's a little bit of a headwind for earnings for S&P 500 stocks. It also lowers our competitiveness. As the dollar strengthens, as we sell products abroad, it becomes more challenging to do so. And lastly, and on a slightly more positive note, lower levels of inflation. A strong dollar means that we buy assets more cheaply abroad. So a lower level of imported inflation.
I'm sorry, that question was not on the record.
Sorry.
I apologize. My question was, does a strong dollar help China in their efforts to become the currency for the world?
I think it underscores the fact that there is a problem having one major reserve currency in the world, and that being the dollar. And typically in the past, when you've seen a very strong dollar, you've seen something great. We saw the Latin American debt crisis in banks in the 1980s. In the late 1990s, 1997 in particular, we saw Asia markets sell off dramatically because of currency. So it does underscore the fact that while the U.S. acts independent and the Fed has their dual mandate, that what they do has a dramatic impact on what occurs abroad. And at some point, they haven't said it yet, but at some point, I believe the Bank of England or someone in the UK government will point to the US and say, we're having all these challenges because the dollar is so strong and it's creating disruptions in the international markets. I think that's coming.
And secondly, what are the concerns of Italy kind of having a Greek-like meltdown?
Well, they're not insignificant. You saw yields have backed up pretty considerably in their 10-year space. They've got a new government. It's the first time they've had a far right-wing government since World War II. They have typically very high debt burdens relative to expectations in the Eurozone. I haven't heard any comments about them leaving the Euro. But I think it's something to watch. Sure. Next slide, it's just another look at the currency imbalances. And again, you see the euro versus the dollar. It's trading below parity now. So each euro buys less than $1. Sterling traded at an all-time low of 103 on Tuesday morning, and it's actually around 108 today, which is again very low. When I lived in London in the late 80s, early 90s, it traded at 2 times the dollar. So one pound bought $2 back then. Now it's about close to parity. And the U.S. dollar is incredibly strong versus the Japanese yen at 144. So you can see on the far right-hand side, that's creating a lot of distress. On the next slide, Kate. Now we move to investments. Look at market volatility. And that's the chart on the left-hand side. That's the VIX, or what's referred to as Wall Street's fear index. And over this period of time, this 30-year period of time, the average of the VIX is about 19. It's at 32 this morning. And there's a saying in the marketplace, when the VIX is high, it's time to buy. And when the VIX is low, it's time to go. So an elevated level of volatility in the market, it just underscores the fact there's a lot of uncertainty and a lot of perceived risk. And that volatility represents that. And as things become more volatile and potentially cheapen up, it may be a better time to allocate into those asset classes. On the right-hand side, and probably even more dramatically, you can see that this is the move index. This is the Merrill Lynch options volatility estimate, and really just looks at bond prices. And it reflects that there's an increase or a spike in volatility there as well. So things worth watching. The next slide, Kate. Now we talk to market returns. On the left-hand side of the chart, you can see those are equity returns, U.S. domestic, non-U.S. and emerging market. And typically, stocks have been, pretty strong and consistent performance. So over this 20-year period, you can see that the returns are clustered for all three between 0 and 10% on average. On the far right-hand side, however, you can see that the last 2 quarters of growth of appreciation have been negative or decline in value. The S&P 500, which is also reflected here, had its worst first half performance since 1962, down 20%. And the U.S. Ag on the far right-hand side, and perhaps that's even more dramatic, is the sell-off in bonds. And the U.S. Ag is at its worst first half performance since 1976, down 10.3%. On average, it's over a 30-year period. The ag's worst performance in 1 year, it was down 3%. It's down 10% already year to date. It's actually even further down so far. And a lot of that has to do with where we were. We came through a long-term secular decline in interest rates, and the backup associated with what's going on in the world and what's going on in our economy has been dramatic. Next page. This is a great slide. This actually looks at fiscal year 2022. So on the far left-hand side, that shows a market rally in the second half of calendar year 2021. And you can see everything was pretty positive. Obviously, some stress in emerging markets, and bonds were down a little bit, but stocks were actually pretty strong performers. In the middle, that actually reflects the first half of 2022, the market sell-off. And the sell-off was so powerful, it really overpowered any returns that we saw in the beginning part of the fiscal year. And on the far right-hand side, you can see everything wound up in a negative return, with one exception, and that being the dark gray bar, which is oil. Not necessarily an asset class you directly invest in, but it's part of your portfolio. And that was up 43% year to date. On the next slide, just a quick look at this reflects the outperformance that the U.S. markets have delivered over a 10-year period. So on the left-hand side, you can see that dark blue or black line up. Those are actually U.S. stock returns. And in the lower part, you see in the red, developed market, ex-US, and emerging market in light blue. And you can see that the returns you've gotten from U.S. domestic stocks have been really quite powerful relative to those other geographic areas. In the middle, it just shows fiscal year 2022, everything ended down. And on the far right-hand side, that actually shows fiscal year to date 2023. It's really 2 months of returns. And notice they were positive for a while, and that was the bear market rally we saw in July and early August, and that sell-off has resumed, unfortunately, with some gusto in September. More importantly, let's look at your performance. So 2 slides forward, Kate, please. So as I mentioned, all manner of U.S. domestic markets and international markets in the public space have had real challenges in both the second quarter of 2022 and the full fiscal year. And you can see in the middle of that chart, those are pretty substantial downdrafts or drawdowns in those asset classes, all negative. I'd say the positive I would take away from this is that you're a long-term investor, and that's your silver bullet, that you can be patient. And if you look in the 5-year sector, you still have generated cumulative positive returns across all asset classes. On the next slide, this looks specifically at your portfolio's public market returns, again, for that same period. We've got the benefit of John Mersenberg is going to join us virtually today to kind of go through in more detail our equity performance globally. But you can see in the middle of the second quarter and full fiscal year right next to that, the markets have been challenged and your returns have reflected that as well. Fixed income has delivered very little diversification benefits because it's had a high correlation with the sell-off in equities. Again, probably because of its starting point was so low, but it's performed in line on a relative basis. So the downdraft hasn't been as dramatic. And again, the positive that I take away from this is on the far right-hand side, that you generated positive returns across all public assets for the last 5 years. Now, I have a little bit of better news for you. So next slide, please, Kate. Private markets, however, have had very, very strong performance. And if you look at the upper portion of the chart, you can see that in the full fiscal year, you've had dramatic performance for private equity, for example, 27.9%. Real estate core up 34.9%. Real estate non-core 32%. Infrastructure up 18%. And opportunistic fixed income up 3.8%. Hedge funds have also performed strongly as a diversification and a non-correlated asset at just slightly negative, at just negative 20 basis points. But look further out. For 3 years, 5 years, 10 years since inception, you've had positive returns across all those asset classes, which is terrific. On the lower portion of the screen, it actually shows your total performance for 3 months and 1 year, 3 years, and 5 years. The good news here is that your plan has actually outperformed its policy target benchmark in all areas. So for the second quarter of 2022 was up 120 basis points, and that's in the middle. 1 year, it was up 80 basis points relative to that policy target. In 3 years, up 30 basis points over the policy targets, and in 5 years, up 20. That's actually a good result. I know that the red on the screen is not very satisfying, but the relative performance is what you're looking at here. On the next slide, this actually looks at the second quarter of 2022's outperformance, and it breaks it down. It reflects, again, 115 basis points of outperformance. And that's broken down in the middle. You can see 35 basis points of that came from over or under allocations to policy weights. And more importantly and more powerful, I think, is on the far right-hand side, 80 basis points of outperformance due to investment manager selection that have delivered alpha for the portfolios. On the next slide, again, this looks at your returns specifically for the second quarter of calendar year 2022. As I mentioned, John's going to go into more detail on the equity side. These are actually excess returns in those sectors relative to their benchmarks. And we've obviously had some headwinds in developed market ex-US equities as well as emerging markets that John's going to go into. I'd say in the fixed income space and more generally, this has actually been relatively strong across all strategies and sectors. And in particular, high yield, you can see that outperformed by 20 basis points in the quarter, and that had to do with active management and active selection. On the bottom of that page, the total the FIRE policy benchmark, you can see that the excess performance has been 115 basis points. Again, rounding, it was up 120 in the other slide, but consistently outperforming your benchmark, 77, 34, and 22 basis points out the maturity spectrum. Next slide. So another look at private market excess return relative to benchmarks that are stated there for the second quarter and then out the curve. And again, you've had significant outperformance in hedge funds, private equity, core and non-core real estate, infrastructure, and opportunistic fixed income. And those excess return figures are pretty dramatic relative to those established benchmarks. And that's a great outcome. On the next slide, just a quick look at some of the rebalancing activities. We actually funded 2 new mid-cap strategies in the second quarter, one domestic and one non-US. And that was funded by raising money by selling some short-term treasury holdings in one of your portfolios and cash. And then we actually bought even some more large cap equity exposure to rebalance the cap weighted to cap weight neutral. Last slide. I think this is the last slide. These are the over and underweights relative to your policy benchmarks. Again, our job is to manage to those guidelines that you gave us. We don't take liberty. We don't do tilts. You can see here we're all within that 2% plus or minus range. And again, we try to stay as close to those asset allocation targets as reasonably possible, given the cost of rebalancing. We take that into consideration when we rebalance the portfolios. And with that, I'll answer any questions. And I should have caveated this earlier. There's no such thing as a bad question, but there may be a bad answer. But I'll see what I can do. So anything I've covered that questions on or didn't cover?
Sorry, is that Shuman?
No, it's Liam.
Okay, your mic's off.
Couple slides back in one of the
That's the output.
No. Go forward. No, right there. Thank you. So since inception on private real estate core and private real estate non-core in the excess, those 2 areas are negative.
Yeah.
Any particulars?
That's a great question, Liam. I'm sorry I didn't address that. That sticks out on the screen, and I should have. That has to do with investment manager selection that occurred before 2012, I believe. So those are legacy issues. So that's actually a long time horizon. And 10 years, I think, clearly tells a better story because it's positive. But I think there were standards put in place and procedures and just an approach to private markets that was put in place in 2012, 2013, 14 that was very well thought out and really has driven that improvement consistently.
Thank you.
Could I just make a quick comment on the public fund rankings too? when you look at your ranking for the year, which is in the full quarterly report, you were just below median for that trailing fiscal year period. What a key observation that we're making and discussing with our clients is a lot of disparity between public pension funds and how they perform, the range of returns in that universe. I think Steve talked about the Tux universe. The larger public funds, which I think the sample is about 70, ranged between kind of positive 3 or 4% and as much as negative 15%. So you were kind of right in the middle, just a little below the median. And the difference is in a market where stocks and bonds were both down in the second half of that fiscal year was really private markets and how they were implemented and the level that they had. The median public fund has, between 20 and 25% in illiquid securities, depending on how you measure it. Some of the big public fund pension funds have put 30, 40% into real estate, private equity, and private credit. And they have that lag effect. So they had less in the public markets because they had more in privates, but those returns will creep into the private markets returns over the next couple of quarters. So you'll see a little bit of a normalization, but definitely an extreme range over that 1 year period. When you look out over 10-year periods, the spread between the kind of best and worst is usually 2%, maybe 2.5%. So your rankings, as Steve mentioned, you're ahead of your policy index over the 7-10-year period. You're ahead of the median fund. Your portfolio has evolved over time to add more private markets. We all recognize the New York City retirement systems are more of an aircraft carrier than a battleship. But when we think about the battleship that's the fire pension, you've kept hedge funds, which were Diversifier delivered this year and over the trailing period, much better alternative than bonds for the last 5 years, giving you a higher return. Bonds are 1 or 2%. Your hedge fund portfolio is doing much better with about the same volatility and less interest rate exposure. So, we think the plan's doing well. I know John's going to cover the equity portfolio, and there's some pockets in there that you'll see some growth value shifts and a couple of managers we're keeping an eye on, but I just wanted to add that. Thanks.
Yeah, that's terrific. I should also reflect that the marks on the private assets, private equity, private real estate, core, non-core, and infrastructure are marked with a delay. So those prices are as of March 31st. So we do have some insights into what the marks look like for the end of June. We don't have all the data, but as a general matter, private equity, we think, is down, looking at 70% of the returns that we have so far, is down about 3.3%. Real estate is actually up a little bit because of the decisions that were made and the selections that you made as trustees early on in the pandemic. We were buying into a lot of the weakness. And infrastructure, because the demand is infrastructure is up. So I think that's happening, and it shows the benefits of diversifying private and public. And the brilliance of the private assets is your investors. So the managers don't have to take action and sell into a soft market. They can be patient and hold.
You mentioned China's zero COVID policy. How long, if they were to soften on that and they would start to get back to work and produce and export, how long until we see some sort of reaction? Is it a month, 3 months, half a year?
Those supply chain vary. I think that's probably a longer term process. They have their parliamentary vote this, and I think it's in 2 weeks in China, and perhaps Xi Jinping is reelected again for unprecedented third term. I don't know that he'll change his policy. I don't have a crystal ball. But if they were to loosen that policy, I think the concern is that the vaccination potency isn't as strong as we have here domestically in the States. So that could be more problematic for them, and you could see a spike up in COVID.
This is Eddie Brown. Xi Jinping has more problems than COVID right now. He has the real estate market in China is a mess, right? Yes. I mean, basically they're defaulting on people's life savings. The birth rate is down. They got many issues. Taiwan is in the future. I mean, they have a lot of issues. I believe the dollar's currency, if I'm not wrong, is that it's still a United States dollar, U.S. dollar is still a safe haven for the world. Am I correct on that?
Oh, absolutely. And actually, the dollar recently traded at perhaps an all-time high versus yuan at 7.2.
Right, and the S&P what is it, 30% of the S&P is foreign, that gets hurt by the strong dollar. But there's no chance of China passing the US currency as the number one currency right now. There's no chance of that.
Not for a long time. I think that's right.
So I'm mindful of time here. So I just want to put this out to folks that take a look at the presentation. It's in Convene. You have copies of it. If there are things that you would like Steve to highlight in the future or speak less about in the next iteration of this, please feel free to let us know. The intention here, and I don't want to speak for Steve, but the intention here is to make this as consumable as possible for the board and to use the time the most efficiently that we can and hit the issues that folks want. That doesn't mean take a Halligan to it. That means just, let me know around the fringes and we'll massage a little bit.
There's no pride of authorship. And again, I really want this to be useful to you as trustees. You have a lot of responsibility. I'm here to support that in any way I can. And we have the benefit of almost all the BAM team on the line as well. So if there are specific questions, we have all the experts as well in any other area, asset class.
So we're going to move on in the agenda, and we have a risk update that I believe is next up. It's probably easier to use the microphone. Yeah, that's probably an easier. No, this one that that one's probably easier. So Ed Berman's here. I think Ed's have you been to this board once, at least once before? So Ed is the Chief Risk Officer. He's going to walk us through a risk update. And again, if you have questions, feel free to ask them. We want this to be interactive with folks.
Yes, thank you. Thank you for the introduction. Can we have the first page, please? And just to second what John just said, obviously we're looking for the feedback, and you notice that we use it as an opportunity to change some visuals and do a refresh of the risk presentation. So let's just dive straight into it. So the total risk for the plan for this quarter, for the end of Q2, stood at 11.5%. And you can see this number in the bottom right corner of the table. But what does this number mean? What is the intuition? Is it a number we should worry about? Is it a number source of concern? Broadly speaking, the risk in the portfolio is a function of two decisions. First of all, it's a function of markets. And second of all, it's the portfolio construction process. And the most important part in the portfolio construction process is to decide the equity allocation, the stock bond split. So we captured that in the column 1 of the table. And that's what we call the market portfolio. And it's just a standard 65-35 blend, meaning 65% of MSCI equity, which is the broadest measure of equities, and 35% of Barclays domestic US Ag, which is the broadest measure of the domestic fixed income market. The next step in the portfolio construction process is the asset allocation. And that's where we split these two asset classes into more granular buckets. US equities, emerging market equities, core fixed income mortgages. So this process is captured by the policy benchmark. And you can see it in column 2. Just for the reference, at the bottom of the page, you see the 12 components of this policy benchmark. And finally, the last step in the portfolio construction process is actually the day-to-day portfolio management. This is the choice of managers, any intermediate cash flows, rebalancing, and all the things that go like cash management. And that's, of course, the plan itself, and that's captured in the column 3. So with this framework, it's much easier to see the impact of the markets, the portfolio construction, decisions we make day to day. So let's start with the market portfolio, the 65-35 blend that we see in the column 1. Let's start with the portfolio construction process. And broadly speaking, the portfolio takes exposure in 3 dimensions of risk, which broadly speaking, the 3 opportunities to make money. and that's equities. This interest rate, which is time value of money, and finally the credit spread, which is the risk of default. So by construction, our equity allocation is 65%. The interest rate exposure is usually measured by duration, and you can see the duration of this market portfolio stands at 2.3 years. So what does it mean? I usually think of duration just as scaling factor. It's simple conversion from interest rates to market value. So a duration of 2.3 means that a 1% decline in interest rates means a 2.3% increase in market value. That's all there is to it. So the interest rate exposure is driven by the Barclay US Act. Every single instrument in this basket has the exposure. The credit spread duration is somewhat similar. Again, it's a simple multiply. Spread duration of 1.4 means that a 1% drop in credit spreads means a 1.4% increase in the market value. Again, it comes from the Barclays Act, but you'll notice the number is smaller, and that's simply because not all components of the Barclay Act have exposure to credit risk. As a matter of fact, about 60% of Barclay Act is government, U.S. treasuries and agencies. That's why this number is small. So how does this translate into risk? You can see at the bottom of the page. So the total risk for this portfolio stands at 12%. And what this number represents, you can think of it in terms of the performance. So 12% of total risk simply means that our expected performance for the portfolio in the next 12 months will be within a 12% range, meaning a gain of 12% or a loss. And on top of it, there's also about a 15% probability that the gains will exceed plus 12%, and also about 15% probability that the losses will be steeper than minus 12. You'll notice this total risk for this quarter is up almost 1%, which is a fairly significant move. And the reason for that is just markets. So we obviously are hitting a very unusual, very volatile period in the markets. I think everybody follows the news will know about that. And the Q2 performance was very turbulent. It didn't get any better, as we know. And the volatility in the equity markets runs at almost double the level pre-COVID. And the action is even more severe in the fixed income markets as measured by the MOVE index. I think Steve just talked about it. So the volatility in the fixed income markets runs at about 3 times the pre-COVID level. It's somewhat comparable to the global financial crisis. So we're talking about extreme levels of risk. So it's not surprising that the market portfolio is up by almost 1%. The second measure of risk that we show here is the beta to the S&P 500. And what it is, it's a measure of a more shorter term moves. Remember, we mentioned that total risk is calibrated to a 12 months, 1 year move. The beta is more of a measure how the portfolio will perform if the S&P were to change. So beta of 0.6 means that the 1% increase in the S&P translates in about 60 basis points increase for the portfolio. Notice this number is lower than the 65% allocation to equities. And that's the result of diversification. So this is where we get some diversification from the international markets, but also diversification from fixed income. So we use this result, this market portfolio, as a baseline for further analysis. So the next step is the policy benchmark. And again, this is where we introduce the asset allocation. So we focus on column 2 and first start with the portfolio construction. Obviously, the equity allocation is similar, 65%. You'll notice that interest rate duration is slightly lower. So here we see about a 0.4 year drop. And that's simply because within our policy benchmark, we have a sizable allocation to high yield. So high yield tends to be of a shorter maturity. It's usually up to 5 years. And that brings a low level of duration. You also notice that the spread duration is low, and this is because of the TIPS allocation. So this is for the inflation protection. TIPS being government bonds obviously carry no credit risk, and the level of spread duration is slightly lower. How does this translate into risk? You see at the bottom of the page. So the total risk actually came down. It's 11.2%. And that's a good outcome. It came down because of the diversification. So the whole point of the asset allocation is we introduce more ways of making money, better revenue streams, while keeping risk constrained. And I find it's comforting to see this number below, especially in the current environment. We're obviously facing high inflation. This is a historically unusual environment, but still the asset allocation is holding pretty well. The change in total risk of plus 1% is completely in line with the market portfolio. So here we get comfort of knowing that our policy benchmarks change in line with markets, so we have no concerns here. And finally, the beta at 0.57 is lower than the market portfolio. And that's again because of the diversification, but to a large degree, the drop is because of the private markets. So it's not surprising. So how does this translate into the portfolio? So let's just focus on the last column. And let's start with the portfolio construction. You will notice that there's a slight change in equity allocation, which will go in more details on the next page. The short answer is not material. It's within daily rebalancing ranges. The interest rate duration is essentially the same, maybe slightly above, but again, it's not a material overweight, and the spread duration is in line with the benchmark. This small changes you see largely because of the ETI allocation, which tend to be longer matured. So what does it mean for the risk levels? They're very comparable to the policy benchmark. So I hope no surprise here. It's a good outcome. You see that the total risk went slightly higher. It's 11.5 versus 11.2. And that's to some extent driven by our allocation to active managers, but by far beyond is the private assets. You'll notice that the beta to the S&P is again in line with the benchmark. No big surprise. And here we introduce the third measure, active risk. So just remember that we define total risk in terms of performance. So this is absolute performance, a measure of expected performance for the next 12 months. Similar, active risk is the expected excess return of the portfolio over the benchmark. So the active risk of 1.8% means that we expect the excess return over the policy benchmark within the next 12 months to be plus minus 1.8%. And of course, there's a 15% probability it may be better than that or worse on the downside. And we'll go in more details on the next page what this number means. But again, to a high extent, it's the private markets that drive this active risk. No big surprise. But before we dive into the portfolio, I just want to draw your attention to two charts on the right. And here we show some historical evolution of these risk measures. First, starting with chart 1 at the top of the page, we show the relationship between these three portfolios, total risk. And you can see that over the last 12 months, the relationship held up pretty well. It's been steady, consistent. There's some fluctuations, mostly because of the markets. And as volatility in the market picked up in this year, you see that all these portfolios started trending higher. So no big surprise here. It's entirely consistent. And finally, the same thing for the active risk at the bottom of the page. Again, very steady. It's a huge portfolio. You don't expect big jumps. So that's a result exactly as you would expect it. The number was probably a bit lower at the end of last year. It's about 1.5%. It went slightly higher. We're not talking about big numbers, but it's not surprising given that the volatility in the markets increased. Okay. So this is like the top view across the entire portfolio. Next page, we dive a little bit inside the portfolio itself, and we'll look at the individual asset classes and their contribution. Now we skip ahead. We need to go back, please. Thank you. So first of all, let's start with the portfolio allocations. You can see them in column 1. And just as Steve mentioned a few minutes ago, no big surprises. You'll notice that public markets find beyond within the ranges. There's a small deviations here and there, but it's within like daily noise and daily volatility. Where you see some bigger differences are in the alternatives, specifically private equities running slightly over the target. We're talking about small number, 1.5%. And private real estate infrastructure slightly behind. So no big surprises. The next column, total risk, shows the contributions, the exposures rather, for individual asset classes. And actually the same information is shown in the chart below. So I'll focus on the chart. It's a little bit easier to track it. And here the allocations are shown in blue colors, the blue bars, and the risk contributions are in orange. So several observations to make here. So first of all, you'll notice that two buckets, two asset classes punch well above their weight. And this is U.S. equities and private equity. And it's not surprising. We all know that equities come with high risks. Specifically, U.S. equities, U.S. developed being the most advanced economy, developed market. But the U.S. equities also have to be one of the riskiest asset classes in the world. It comes with high level of volatility, which is driven primarily by high exposure to technology. So that's being, we've all seen in the news, technology companies go in and out, and that's what largely drives the volatility. You also notice that the fixed income allocations, specifically core fixed income and tips, serve as a useful ballast in the portfolio. You see the blue bars, the allocation, but the orange bars are almost invisible. So that's the diversification, and that's exactly what you would expect from a multi-asset portfolio. So everything is working as it should. So no big surprises here. We next look at the active risk. And again, active risk is a measure of excess returns. And again, this is consistent with the asset allocation and with our manager selection. So in the public markets, our active risk is low. Public equity runs at 80 basis points. And you'll notice that U.S. equity at the top of the page runs at a low active risk. And again, this is by construction. But developed markets ex-US, where we take more of an active manager approach, you notice that active risk is higher. Again, it's in line with the investment process and with our manager selection. On the fixed income side, being more benchmark aware, the risk is low, actually very low. Where you see big numbers, it's in the alts. And again, this is not surprising. That's exactly why we go into alternatives. So everything is functioning as expected. But what's interesting is to connect risk with performance. Because we keep mentioning that risk is all about performance. So let's see how it connects. And finally, focusing on the column 4, you see the returns that for the trailing 12 months. And Q2 was an unusual quarter. Q3 is also unusual. So it's not surprising that some of our risk forecasts didn't come to be. Because remember, I keep saying this, a 15% probability on the upside and 15% on the downside. We're clearly probably in the once, lifetime or every 20-year kind of event. It's a very unusual environment. So not all of our risk forecasts came to be. First thing you may notice that every single public node is colored red. So we have losses everywhere. The U.S. equities actually held up pretty well, both if you compare absolute and excess return against total risk and active risk, it's well within the bound. Where you see the difference is the developed market ex-U.S. And this is, I'm sure you heard the more active managers such as Bailey Gifford, where they delivered exceptional performance in the past, but Q2 was less kind. There were actually significant losses. And that's where you see that active risk of 3% actually translated in the excess losses of minus 7%. Unfortunate, but understandable. On the fixed income side, things are well within the ranges, even though the absolute returns exceeded forecast, which is a reflection of how unusual these markets are. The excess returns were well within active risk forecast. So it's a positive. On the alternative side, again, the forecasts and the returns aligned quite well. The returns were extraordinary. Probably the only place I want to call out is the private real estate, where the returns were well in excess of our forecasts. And that's probably an indicator of how extraordinary last quarter was. Yeah, I'll pause here before we move to scenarios in case there are any questions on the portfolio or any asset classes. Okay, can we have next page, please? So here we introduce, as has been the custom, 3 forward-looking scenarios. So as Steve reminds us several times today, we have no crystal ball, which we don't. We have no forecasting ability and we not pretend to foresee the future. So the purpose of this exercise is to highlight our thinking about the future of the economy and the markets, and also to highlight certain aspects in the portfolio construction. It's more like food for thought and maybe useful as an input for the forthcoming asset allocation exercise. So looking forward, and we're looking probably 6 to 12 months horizon, our base case currently is a slowdown in the markets. I have to say that conviction low is probably low and declining at this point. But the base case is for the Federal Reserve to successfully guide the U.S. economy to a slowdown, this kind of softish landing. As a result, the inflation will moderate, commodity prices will come down. You will see some steepening of the yield curve, even though rates stay elevated. And you will see some challenges for the U.S. corporates struggling with future revenues for a number of reasons. So the spreads will probably widen slightly, and there will be softness in the stock market with about 5% decline in the S&P. The negative surprise, and that's probably a growing level of conviction at this point, where we see the Federal Reserve essentially crashing the economy. Inflation still stays high and rising. And as the Fed is tightening in the slowing economy, the consequences may be quite severe. So in this case, the curve may not flatten anymore because it's already pretty flat, but inverse even further. Rates move higher, inflation accelerates, oil becomes more expensive, and we see about a 15% downside for the US stock market. And finally, there's always a room for the positive surprise, even though it's getting more and more difficult to see where it may come from. Probably the best source of a positive surprise is some kind of stimulus, probably fiscal stimulus, and it may be coming either from China, a very likely source is Europe, the UK is in the world of its own, what's happening right now, or potentially domestically. So with successful policies, the inflation may be coming down, and there's a potential for curve steepening and the stock market delivering a positive 10% return. So what does it mean for the portfolio? You can see the results of the portfolio level in the chart 1 at the bottom left. There's several interesting observations. So while the direction of travel is not surprising, a drop in stock market translates into declines for the market value. The magnitude is actually quite interesting. Notice that at the base case, where stock market drops by minus 5%, translates in almost 4% decline for the portfolio. This is probably more than would have been implied by 65% allocation to equities. For the positive surprise, with 10% rally, the portfolio gains only 4.4%. Again, significantly less than the 65% allocation to equities would imply. The negative surprise is more in line with the allocation. It's minus 9% for minus 15%, but that's probably not what you want to hear. That's not where you want it to work. So what gives? What's the reason for that? And that's where we need to look at the chart 2, where we see the same at the individual asset class level. So let's start with the gray bar, which is the base case scenario. So first thing you notice that all gray bars point in the same direction. It's all down, meaning there's no source of diversification in the portfolio. And that's really the reason why the portfolio is not performing as you would expect. And again, it's not really that surprising, given that the asset allocation was done probably for a somewhat different market environment. Nobody could foresee what's happening now. For the positive surprise when this equities rallied by 10%, the green bars. There is some diversification, which is somewhat unfortunate. The tips underperformed. Actually, the tips delivered the largest detractor from the performance. So it was not helpful. And finally, the negative surprise. There is some diversification, again, coming from tips, but the core fixed income bucket is not delivering what it should. And you'll notice that core fixed income is probably the only bucket where it's losing money in every single scenario. So we thought it's an interesting exercise just to highlight the possible outcomes. And again, just to highlight, obviously, the asset allocation for the portfolio was done for a different market environment, where in the macro environment, it was impossible to predict, and it's not a question how long it will remain this way. So I'll stop here, open for any questions.
So, yeah, can I just make a quick comment on the last point on fixed income, right? It may seem like, why are we in bonds, right? Well, we did an updated asset allocation last year, and the expected return for bonds were set very low, 1 to 2% range, depending on the beta you're choosing and duration. We lowered the duration of your portfolio last year. He just talked about the duration of your portfolio. The duration of your liabilities is 11 or 12 years, and your fixed income portfolio is much smaller size than your liabilities and has a much shorter duration. And in terms of the outlook, thinking a little bit beyond a year or two, we are in a much better place with bonds at the yield level than we were a year ago. So we're going to have more volatility, but as pension investors, we want to have balance in the portfolio, and having a bond portfolio that, in a year or so is going to yield 3 or 4% instead of 1 or 2% is a plus for you. You're already kind of underweight bonds if you're thinking about matching liabilities and assets, which I know a lot of public pension funds don't think about. But believe me, after we get through this market turmoil, you're going to be having more conversations about your liabilities and how inflation and some of the other factors impact that outlook going forward for contributions and benefits. So big picture bonds, I think they should be in your portfolio.
And as bond rates rise, we can take risk off the table, correct?
Yeah, that's part of the equation. And the hard part when bonds and stocks sell off, right, is stocks are becoming more attractive as bonds are becoming more attractive. So we're going to revisit those discussions with Steve and his team when we go through the next asset allocation update, which, should be in the next couple of quarters. We have updated assumptions each quarter that we'll be sharing with him when we close out this quarter. But, tips, he mentions tips. That's a good example of an asset class that we're going to have a conversation about because they delivered in the last 2 years, but they are much less attractive right now. And so we may decide to trim that or make some other change.
So I just want to put out there that Ed and his team are always available to speak to trustees. You want to come in for a day and do a risk day, we'll make that work. Anybody who is interested, any trustees that are interested, I know that my friends in the mayor's office often like to come in and ask risk questions. So we just want to make sure that everybody knows you have that opportunity. Ed and his team are always available to talk to folks. And if there's specific questions throughout the quarter, you don't have to wait till a quarterly presentation. If you got a question, Ed's here. He's a resource. Let's use him. And, don't be shy because I know you guys aren't. Okay. So that
If there's interest.
if there's interest. So if there's interest, just email me and let me know, and then I'll work around whoever wants to participate, whatever their schedules are, and we could do it. Okay.
We'll
Fantastic.
be happy to. Absolutely.
Okay. So with that said, we have one more item in public.
Hold on, your mic went out.
Oh, everybody was very lucky for a second. This is in the category of, okay. Thanks. All right. So this is in the category of trustees have asked for stuff and BAM is answering. So I'm going to turn it over to Allison to explain what you're going to see, and Kate in our office is going to give you a very quick update on something that addresses issues that have been raised by trustees over the last several years that we're trying to get ahead of. So,
Good morning, everybody. So I'm going to be introducing Kate Visconti in a minute, who is our Associate Director for Pensions and is all around amazing. If you ever need anything, Kate is probably the best person to find it. Ignore John, just listen to Kate. One of the issues that became clear when Brad became controller and I joined the team is that it was very difficult for us to figure out, for me to figure out where our money is invested at any given moment. And I would have to email Ed or Dan in risk and say, how much money do we have in this manager right now, et cetera. And all of that information is actually publicly available in Convene on the website in these like super dense, 100-page PDFs that we get from State Street that I can't read. I'm sure others feel the same way. Maybe you're better at it than I am. But one of the things we wanted to do was make the information that is the trustees' information much more easily accessible and searchable. And so Kate really has spearheaded this project to revamp the controller's website. So it's a public-facing website because it is all public information that's already up there, just unable to be deciphered, so that any of the trustees, any of the members can actually look at what our AUM is at the moment by manager, by asset class, what the performance is by manager and by asset class. So with that, I'll hand it over to Kate and she will walk you through it.
Morning, trustees. Allison, thank you. And trustees, thanks
sorry,
for
Kate, I was just sorry to interrupt. I just want to give you a little bit more of a shout out. As someone that's new to the team and new to the portfolios, I look at this website every day, and it is incredibly valuable. And I hope you'll agree that it's useful. So go ahead, Kate. Sorry.
No problem. Thanks, Steve. And yeah, we hope it is as useful as it is to Steve. So I'm going to give you a quick overview of the tool. I'm going to show you a few ways that we think you might want to use it, but I'll be mindful of time and keep it quick. So as Allison said, do keep in mind as I go through it, though, that all of the information here is already available to you in your PDFs. It's already publicly online. This is just much more user-friendly. So right now you're on your assets under management page and you're looking at the data for all 5 systems. So let's zoom in on yours. You can do that by clicking Fire basically anywhere you see it. You can also use up here, these are filters, so you can select Fire here. So now we're looking at this dashboard specifically for your system, and we can select, let's say, as of June 22. So we're looking at your system as of June 22. Up here, you can see the total net asset value. You have 18 billion. Over here on the right, you're seeing that same 18 billion. It's the units in millions, but you're seeing it broken down now by asset class. So you can see, for example, in private equity, you have about 1 billion and change. Over here on the bottom left, you can see that same asset class broken down information, but you're seeing it visually. You can quite easily tell how large, for example, public equity is. And over here on the bottom right, you're seeing what is probably going to be the most useful section of this tool. You're seeing all of your investments listed with their corresponding net asset value over here, and their asset type, and so on. So let's dive into an example. Let's say you're interested to understand all of your investments and their corresponding net asset value in private equity. So you could do that. You could, again, click anywhere you see private equity. You can also go up here to the filters and select private equity. So now we're looking at this dashboard for your system specifically as of July 22 in private equity. So over here in the top left, you're seeing you have, again, 1.6 billion in private equity total net asset value. These become quite simple, but then in the bottom right, you're seeing, again, all of your specifically private equity investments with their net asset value. And as you scroll down, you see they're all listed here. For example, let's say EQT Fund 8, you can see right here that you have 28 million in that investment right now. So let's say you're interested in EQT, but you know that you have investments with EQT that exist outside of private equity. Right now, you can only see private equity. You would go up here and remove that filter, go over to investment name and type EQT. And as you select these investments, you're seeing the dashboard populate with all of your EQT investments across asset class. So you can see here that you have EQT investments in infrastructure. You also have EQT investments in private equity. You have a total of 137 million with EQT. And then down here on the bottom left, you're seeing that visually. Again, it's quite clear you have about 2/3 in private equity with EQT, about 1/3 with infrastructure. And then the bottom right, again, is probably the most useful area where you're seeing all of your EQT investments and their corresponding net asset value. So let's say for whatever reason, it was a member who was interested in EQT. You can go ahead over here. You see these 3 dots, export the data, click export here, and that'll pull it out as an Excel spreadsheet that you can use however you'd like. So that's an overview of the assets under management page. We've broken out asset performance into a different page now. So you might remember on the existing website, we do have performance year to date, and that remains over here in the top left corner. So you have, for example, performance as of, let's say, April 22. You can see for your system right here, that's fiscal year to date as of the end of April. Over here on the right and down below, you're seeing your total performance year over year. And then you're seeing that represented in a graph form. This right now is showing you your total portfolio overall. If you want to look, for example, by a given asset class, you would just click this filter, let's say infrastructure. And now what you're looking at is your infrastructure returns year over year. The data is here, and then it's visually represented down below. So trustees, that was a sort of a whirlwind overview, but we're very cognizant, as Allison said, and John before her, this is your data. So your feedback is really critical. If you have any questions, I'd be happy to answer it now, or you can email me anytime.
Just out of curiosity, is the data in this coming directly from the custodian database?
Yes. Okay, I'm answering yes. That's an accurate answer, correct?
Yes.
For somebody who used the comptroller's website, thank you. This is 1,000 times easier than what it was.
So we expect that this will go live. Right now, this is the demo site. We wanted to present it to each of the boards this month. Fire's the last board in September. So we expect this will go live in public sometime next week.
Best part about the old website was the color coding.
The color coding.
Okay, so with that, that concludes the public agenda. I'd like to make a motion that we exit the public session and enter the executive session. Okay, that was a so moved. Okay, so
You
I
need a
would
motion
like
to go
make-
into public?
So
Okay.
we're now in public we're about to go into public session. So I'm making a motion to enter the public session of the firefighters variable supplements fund. Is there a second? Second. Thank you, Commissioner. So Pat, if you could call the roll.
Certainly for the UFA VSF, for Mayor Adams.
Oh, Phil Dukes just, his mic is out, said yes, that he's
And for Controller Lander,
Don Dorson.
Commissioner Nyblock Finance. Okay, Shimon Ray, that is for the UFA. Also, we have Mr. Robert Eustace
Present.
and Mr. Eddie Brown.
Present.
We have a quorum.
So I'd like to note the receipt of the quarterly reports, which are in convene and will be posted on the controller's website. So I'll make that motion to accept those. I should say I'll make the acknowledgement to accept those. And then if there's no objection, make a motion to exit the firefighters variable supplement fund and enter the fire officers variable supplement fund.
Second.
Pat, if you could please call the roll for the
Certainly.
FVSF.
For the fire officers VSF for Mayor Adams. For Commissioner, for Controller Lander.
Endorser.
And for Commissioner Finance Nyblock. And for the UFOA, Mr. Christopher Jensen. Mr. William Guilfoyle.
Here. So again, like to note the receipt of the quarterly reports, and those will be posted with the other quarterly reports on the controller's website, and have been furnished to all of the boards. We'll note that receipt. And with that, if there's no other business of this fund, I will make a motion to enter the public session of the fire pension fund.
Second.
Thank you. So, Pat, we are now in the public session. I believe the roll call remains the same from the executive session. So, would you like me to do the readout? No problem. So, before we adjourn this meeting, we'd just like to note that the board heard from several investment managers involving potential investments, details of which will be made public at a later date. So, with that, I'd like to make a motion to adjourn. All those in favor, please say aye. Nay. Abstain. The ayes have it, and we stand adjourned. Thank you all.